In this episode of The Ownership Economy, Jahed and I speak with Jake Lynch from L1 Digital. Jake is a rare breed of researcher, operator, and investor, and is working at the heart of the Web3 ecosystem. L1 Digital invested in Molecule, a decentralized biotech protocol porting intellectual property into Web3 and launching biotech DAOs. It is a deal that Jahed and I followed L1 Digital into, and so we wanted to better understand Jake's thought process on investing, how he stays current as both a DAO contributor and investor, and get insights generally on the ownership economy. We hope you enjoy the episode as much as we did.
Thanks for joining us, Jake. We like to start these things off basically just by having you tell us a bit about yourself. So where does your story start and how did you enter the space?
Yeah, good to be here. Yeah, so I entered the space right out of college in like the ICO era. And back then there weren't really many jobs in the space. So you kind of had to find different things to do. I was doing accounting at the time and I knew accounting was not what I wanted to do long term. I was drawn to crypto because I had studied economics. My generation, I think everybody's at least remotely interested in technology. So there was a major intersection, and the hype around Ethereum and in college at that time was palpable. So it drew me to the industry. And then the way that I officially got started back in the ICO era, there was an organization called Concourse Q that Scott Lewis started up. And the goal of Concourse Q was to essentially do open source, public facing, investor grade diligence on ICOs. So a ton of people were aping into different ICOs and people were getting scammed. Everything bad was happening that you can imagine.
Oh, and also before you continue further, just so we de-jargonify things, can you redefine ICO if some of folks don't remember what it is?
Aping in. But I think there are three other things in there.
Yeah, definitely. So initial coin offering is ICO, right? And aping in is, of course, investing into something without really understanding the underlying, or even if there is an underlying in a lot of these cases. So it was a very dangerous place to be investing in at that time. So Scott recognized that we needed to do some sort of self-regulation in the industry. And so Concourse Q got started, and I was one of the first people to join formally. And I did that for several years, even into other jobs on a part-time basis. So that was really how I got into crypto. And at the time, the job was pretty much just reading white papers, reverse image searching founders to see if they actually exist, doing all sorts of forensic investigation.
Nice. I mean, that seems like it's necessary for some of the non-founders out here. Are these, whose alter ego is this? So yeah, that totally makes sense. And we're talking about this was 5-6 years ago?
Yeah. About, I would say 2016, 2017 era was when it was about the height of the scamminess and the weirdness in that. But yeah, I mean, we talk about a non-founders these days in rug pulls, but back then they weren't even a non-founders. I mean, they were completely made up founders in some cases. We found Russian botnets of LinkedIn profiles that were all interconnected to make them look like they have some job history and references. They make a non-founders look reputable.
Nice. So this was kind of the space that you entered then around 2017. You have these initial coin offerings, they're not exactly like, I don't want to analogize too much for folks who don't know what they are. They're not exactly like initial public offerings. It's more like a bunch of folks came together, and it's really more like a Kickstarter than something else, right? Where it's like you're initially raising funding for something just because it has the word initial in it. Don't be fooled, right? So that's essentially, it's more like we're raising this thing, we need some money, and then, as Jake mentioned, a ton of people would just abscond with the money, or the initial allocations would be huge for the teams. I remember seeing some things from that era where we're seeing I'd say there's some emerging standards now with founder teams. It's like 15%, 20%, 25 sometimes, right? But it's not like going not much further than that. I remember seeing stuff like 50% founding team, immediately vests, zero cliff, all that, right? So
without a doubt. I think Kickstarter is a really good comparison here, because at the time we didn't even have the word token economics. That wasn't even a thing. And the idea was these tokens didn't really have value propositions. They were more so like IOUs. Kickstarter is definitely what it was a lot like.
For sure. So that's kind of the thing, that the space you entered, it's what you kind of evolved with in the early days. And now if you look back to that, what were some of the biggest challenges of ICOs that you were mentioning, other than the fact that they're suffused with all kinds of FUD from fake people and bots and all that?
Well, yeah. So in general, there was a huge challenge of differentiation because there were so many people going into the market proposing things that were very far off technologically and trying to raise money for kind of like a lot of these cases, like pipe dreams. And I think the big challenge at the time, and it still remains a challenge, but honestly, DeFi advancing the way it has, it's become much less of a challenge, was like market making for these tokens. I remember, so people would have to pay to get listed on an exchange. There weren't decentralized exchanges. So all of a sudden you have this like chicken and the egg where you want to make sure the people who get into this token have some tradability, have some liquidity, but at the same time, you can't really cash out the ICO earnings to pay Binance for the $1 million listing fee. And then you get listed on, if you have this $1 million listing fee, you get listed on Binance, your token spikes. It was absolutely crazy, the market making aspect.
Right. And so since then, what have you kind of seen that's evolved in the market to address some of these concerns?
So the first like major evolution that we saw was around the time of Compound and Synthetics figuring out liquidity mining, which today we have a very different viewpoint on this. But at the time, liquidity mining was super innovative because you had this way to bootstrap. You have these systems that need some like some exit velocity of liquidity in order for them to work, right? Like Synthetics wouldn't work if there's not liquidity because it's over collateralized. Compound wouldn't work if there's not liquidity because the lending rates would be insane. And so you needed to come up with some way to actually get people to come over here. And the big innovation there was, hey, we're going to make inflation and we're going to take this inflation and we're going to give you the inflation. And at the time, everybody was like, this is huge. This is really cool because now all of a sudden there's a cash flow associated with this. So now we know how to value this. And that was one of the initial big questions in the space was how do you value these networks? Everybody came out with like Metcalfe's law. I remember I modified Metcalfe's law to make it look more like a crypto asset. And there weren't really guidelines on how to value these. And then Synthetics and Compound come out with cash flows. The reality, though, is typically your cash flows are not your inflation unless you're looking at like a treasury bill.
Yeah, absolutely. Spot on. And I think and also to break down liquidity mining for some of the folks who might not know about it, essentially, if you think about, maybe I could draw a real world example. I was recently in Uganda, right? And you look at like some, currencies that have no demand for them, right? Like Ugandan currency. And furthermore, because the state doesn't actually bans forming any foreign exchange markets with it. So if you're a Ugandan citizen, in some ways you're kind of fucked because there's no real good price discovery mechanism because there's very hard to generate demand for your currency. And so this, if you kind of back it out to what was happening with ICOs and Jake sort of what you were talking about earlier in the early days of ICOs. So you have this ICO, what are you going to do with it now? Where are you going to get liquidity for this? How are we going to build deep liquidity pools so that if you actually go and make a trade for a currency, it doesn't tank the price completely for everyone who was just involved in it, right? So these were some important sort of things you've seen. One of the other ones I think I'd be interested in getting your take on is, there's so many such jargon. Sorry, Martin, this is the one you're going to have to come up to us for everything. Please feel free to unmute and just jump in and say jargon, explain yourself. But LBPs, TGEs, all the things that the folks they've come up with to sort of skirt the issue that this might be, it's not an IPO, but like, of course, it's, they're like, it's a liquidity event of some kind. It's a treasury generation event. It's not a financial instrument, right? So,
and you skipped over the IEO and the IDO era, right? So so IEO was initial exchange offering. After like initial coin offering, that was just like, hey, you go into these really sketchy smart contracts and you put money in there. People were like, okay, we need something that's a little bit more transparent. So Binance and some of these other exchanges realized, hey, we could do the launch program. And then immediately you have this liquidity, which was a really good idea. And I think like this was the start of like what we see as exchange tokens coming out. Now, I never really got super into exchange tokens, even though like they tend to be kind of the only thing with like a legitimate value proposition on day one, which is like, hey, you have discounted fees, right? But then you switch over to the IDOs, which were the initial DEX offerings. And then things started to get cool because you get liquidity bootstrapping pools like LBPs, these TGEs, token generation events, which is kind of an umbrella term for all of them. But the most important innovation out of all of them, the only one that was truly innovative was the airdrop, right? And the airdrop was this way to say, hang on a second, rather than having people speculate on this, how about we go ahead and find people who actually use this and give them it so that they keep using it and people are drawn to that value. And this was innovative because all of a sudden, rather than having these, what we would all know as like penny stocks trading, you're actually creating a value, right? Like ecosystem of value that has some type of velocity and some type of identity and ownership involved.
Yeah, no, that makes a ton of sense. And I think it's interesting that for everything you mentioned so far, we have like a series of learnings about whether it worked or didn't work, and if it worked, to what extent and how, right? Because I think even now there's stuff, I'm not picking on you here, it's just interesting because I looked at the airdrop, I've looked deeply at the airdrops. There's so much interesting research coming out on airdrops, right? And people are like, I'll put this in the show notes, but I read something recently where it's like essentially, are your airdrop, people had the hypothesis, right? Where they're like, hey, if I airdrop to my community of contributors, are they more or less likely to liquidate than any old holder?
And what was
they're way more likely. They're way more likely to liquidate than someone who invested, which is not almost a counterintuitive kind of finding a little bit, right? Because like it's really interesting, right? But it just tells you, it doesn't mean that airdrops don't work. It's that they don't work the way you thought they worked, and that you'll have to think about how that affects where you're trying to go with a protocol or project you're building, right? And these are, of course, averages. They're not every single project, right?
So the takeaway from the airdrop was only the first one worked.
Exactly.
Because it was an honest, like nobody was doing it so that they could get the airdrop, right? Nobody knew that an airdrop even existed. So they weren't trying to game the system. And so the Uniswap airdrop happens and it blows people's mind. Everybody loves it. And then everybody tries to copy the airdrop. And of course, if you create a game in this industry that's so adversarial, people are going to play the game and they're going to break the game. Right. Absolutely. And this is what we've seen. And now we see all of these. Are you familiar with like the challenge of Captcha?
Oh, yeah. Yeah.
Yep. The challenge of Captcha is that like your AI has to be better than everybody else's AI. Right. Yep. And you're constantly in this evolution. And that's the same challenge you have with the airdrops is your airdrop scheme or Merkle tree has to be more sophisticated than the users can try to figure out. Right.
Absolutely. And there's definitely something in there. I think this is like, I'm diverging too much, but it reminds me of like Ashby's law of requisite variety. There's definitely something in there around like the system that you're trying to build. Absolutely. I'll throw that in there. Cybernetics jargon for all the cybernetics whizzes out there. There are a few weirdos in crypto who are into that, my block science friends and all the common stack people. But basically, essentially, the system you're designing has to be at least as complex in its states as the one that you're basically as the agents who are going to interact with it, right? And so like there's definitely something there to what you're saying around airdrop design, where the states that any individual agent can occupy with it, they're going to discover all the ones to get, and you better have thought of all the ways to fill in those gaps, right?
And you're one team and they're like 100,000 people. Right.
Yes, good luck. But this is also, it's funny enough, now I'm turning this to an ad for block science. This is also why things like block science, AMMs and PMMs and stuff like that have come about, because they're like, oh, this seems to be a problem. Maybe we can solve this with agent-based modeling, right? So the game moves on, right, to other sorts of territories. Super cool, man. Thanks for that background, because I think that actually dovetails really nicely into what you're currently doing now, because you've had a chance to see the adversarial games, the rugs, you've done a lot of investment research. Now that you're here, you're at L1D as an investment manager, research manager. Can you tell us a bit about, maybe start as broad as you like, but how has this background informed how you invest now, right? And tell us wherever you like, with your framework or how you think of investments, like how did it filter down to your work today?
Yeah, it's interesting how there's a lot of like pre-existing knowledge that you can take from Silicon Valley VC that has been really well documented, really well explained and tested and whatnot. But crypto VC can only take so much from that. I think the challenge with crypto VC is that like the major differences here are, one, you bring in a context of economics that typical businesses don't actually really focus so much on, right? Like when you have these complex token dynamics, you have all of a sudden, you have to focus on supply and demand in a way that people without tokens don't have to focus on, right? You have to focus on market making, like I said, in a way that people without tokens don't have to focus on. Uber doesn't think about that, right? And so for all of these things, you have to kind of contextualize where they are in the cryptoverse. So the investment framework, I think, really breaks down to, and any investment framework breaks down to, depending on the stage, top down and bottom up, right? So top down, you're looking at like, hey, where does this fit in the broader scheme of crypto? Does it make sense in the long term? And also, will this sector grow in the long term, right? And then the bottom up is, of course, are these the right people to do this? What are the risks involved in this? And will they step on landmines? What is the probability of them stepping on any landmines, right? And depending on what stage you're investing in. So if you're investing earlier stage, you put more emphasis on this bottom up. And if you're investing later stage, you have to focus more on the top down. And later stage in crypto, everything's early stage, right? So it's kind of like a misnomer, but it is really, I like to categorize the difference between late stage and early stage in crypto as two things, like whether or not what is the probability the team is going to pivot from here? And then also in terms of how much of this vision relies on these actual individual members of this team, right? Because the later stage you go, the more you can plug and play certain people and it's more durable. So that's kind of how I break down my overarching investment framework. And then within each investment, I think what you have to do is you just have to dig through these things and you have to ask yourself every question that you want to push to the back of your head, right? So every question that you don't want to know the answer to because you really like these founders and you want to invest in them, you have to ask that question and you have to ask it to them. And then you have to see is that make or break, or is that something that we can get over? Is it an obstacle, right? The obstacle in the path becomes the path. So that's how I think about it.
Yeah, that makes a lot of sense. And I think an early thing you mentioned early on in that answer is you were talking about Silicon Valley frameworks for a lot of this stuff. And what you just walked through touched on some of that stuff, especially around founders, the founding team, how they work. Is their vision expansive enough? Is it creating a new market category? How is that category evolve over time? You mentioned a lot of interesting things there. I think you're uniquely positioned potentially to tell us than we've had other folks. There are definitely other folks in this universe, but with your experience in crypto research and crypto investments, how much of that do you think it's one for one? Like if you looked at the way that Silicon Valley, maybe some of the chops you developed and took out of what they do, and honestly, same here. I came up out of Silicon Valley myself. How much of that applies? And then what are the new bits? What's the novelty when you're in crypto where you go like, I'm going to have to kind of just ignore that. It doesn't apply here.
Yeah.
What's the delta?
So I think the major delta comes down to the token, right? You can apply your traditional Silicon Valley frameworks to companies like Infura, Alchemy, like these Coinbase, right? All of these companies that have traditional equity models with traditional startup problems. It's the same playbook as it's always been. As soon as you bring a token into this, it changes everything. And the idea there's a lot of reasons a team wants a token, but there's only so many reasons that it makes sense to have a token. And this is where all of a sudden you kind of have to evolve the VC model into, hey, most VCs want a token for one reason, because you have liquidity and you've now entered the IPO stage, right? The reality is you should want a token because it's absolutely necessary, right? And why would a token be necessary? Well, I think the value of a token comes down to really one thing. And often I get a little bit frustrated when I hear people conflate the value of a token with decentralization. Tokens by themselves are not naturally decentralizing, right? Like anybody can go into a token and buy up huge amounts. We've seen this with every token. I mean, the Gini coefficients of most tokens are they're really bad Gini coefficients. It looks like.
Absolutely. We harp on this all the time. Like just because you want to decentralize doesn't mean it's going to happen, right? Like you're North Korea.
It's a cost, right? Like to decentralize, it takes a lot of cost. But the real value of tokens is this magical ability to intermediate markets that previously you couldn't intermediate, right? So to say all of a sudden I go from a token with a representation of this asset to this asset, and there's just simply no way you could have done that with your US dollar bill or with your Apple stock or something like that. So this is like, if this company needs this market intermediation, needs to be expanded so that it can be tradable, all of a sudden tokens make a lot of sense. The other side, and I'm sure we'll get into it, is tokens a lot of the time look like equity, right? And when you're managing a treasury and whatnot, there's all of a sudden a lot more implications there on the regulatory front, on the social and governance front, and all of these different areas that come into it that just previously did not exist in Silicon Valley. Building on that, I think kind of like the last real delta here is the idea that stockholder and stakeholder model, right? All of a sudden, your stockholders are now your stakeholders. Your stakeholders are your users, your developers, your miners, all of these people who have an interest in this ecosystem. And that is completely different incentives than what we typically saw.
Got it. And I think like you said something super interesting that I'd love to hear more about, which is a lot of folks in the space echo this for sure. My buddy Tomer at Flory Ventures, he's also, he would hate it that I said this, but a tokenomics expert, right? Like other people call him this and he hates it, but essentially just, people go to him and are like, hey, should I have a token? And just like you, he says, like, you do not need a token. You absolutely do not need one. And, people are like, well, why is the VC telling me I don't need a token? Don't they like these things? Don't they want to have liquidity faster? And he's like, you absolutely do not need one. I need to hear the case for why. And so for you, Jake, I'd be interested to know, like, this is a super broad question, so feel to shape it however you like. But when should a founding team or a founder who looks at this go, like, what does it kind of look like for them? They're like, oh yeah, I definitely need a token. Right. Like this is something that you hinted at it a bit with like market making between markets that would never exist and what have you. But when is it a tip even, or like that they're on the right path for considering a token?
Yes, I think it makes a lot of sense to consider a token when you have a protocol or a organization that you want to distribute the governance rights. I think that is an area where crypto really thrives, is to be able to give decision making and like to empower people to make decisions permissionless manner, right? They can express their opinion because they now own this token. That being said, most startups in the world don't want to hear what all of everybody's opinions about what they should be doing, because that's a really, really destructive idea. Could you imagine like going into Boston Common and being like, hey, does anybody have startup advice? It would be the dumbest thing you could ever do, right?
Yeah, absolutely.
So I think, there's organic projects, right? Like if you're coming out Bitcoin all of a sudden, right? Bitcoin would have been great if it had a governance token. It really would have. This is a great example of a token. Most things in this space really are regretting their decision to go with a token model. And I think in general, if you start to kind of mix VC funding with external funding, you have to really question your intentions.
God, that makes a lot of sense. So basically, to unpack that a bit, you mean it maybe in a situation like where you've taken on venture funding, maybe you did it as a SAFT or a safe with a token warrant, and then you also did an LBP or something like that. That's maybe puts you in a situation where you're like, oh, what are actual intentions here? That's to clarify?
Yeah, absolutely. Like if you want to do an LBP, if you want to be a community run project, you should do that out of the gates. And I know it is hard to get to that point where you have the smart contracting, the talent that you need to do it. But Linux was built open source, right? Like these things can be built open source, and that's kind of the beauty of it, right?
Yeah. And then I think like there's this emerging space as well in public goods, right? That I'm not going to name too many names here, but just because I don't know how public some of their projects are, but some of these things get off the ground with 70K in funding from Gitcoin, right?
Exactly.
From Gitcoin grant round. Or there are some folks now who are trying to think, what if Gitcoin was only that? And what if we could make like a gigantic public goods funding primitive to augment that? So there could definitely be things that emerge from that. It's interesting how when you look at some of the things that might be considered, I would consider Uniswap a public good until it decides to turn on its fee ratchet, right? Basically. But I think like things like that have really windy paths when you consider what you just said. And Uniswap takes on venture funding, and then they get to a spot where they're like, this is weird. Let's give all of our governance to like institutions and ostensibly public institutions that will help us do this, right? The VCs are like, yeah, we don't want this. This feels weird. Let's give Stanford's endowment a bunch of our governance rights, right?
No, 100%. Governance is this really delicate issue, right? And I think we've talked about this a lot, but the weird thing about governance is like the value of governance. I used to say it's kind of like an upside down horseshoe, right? In that like the marginal utility of governance increases drastically up until a point where you have too much governance and then it starts to decrease. I've since realized that it's not even a upside down horseshoe. It's like a cliff and it goes straight up. And then as soon as you get to a certain point, it becomes negative. It becomes a liability, right? And so I think when you're not very conscientious about who you are giving these governance rights to, because you have started to get funding from different sources, it can be incredibly problematic, right? And I think we saw that with Ferrari in terms of how this governance gets really messy really quick when you bring in something like that.
Absolutely. And I think that might be worth diverging a little bit into, because Faye has become not just Ferrari, Faye, like what materialized from that hack and that event, even within the last few weeks, has become very contentious, rightfully so. Maybe you could tell us a little bit of the specifics of that to dig in a bit more for the audience.
Yeah. I think it's a really important thing to follow. And also, it's one of the things that I found to be one of the more interesting areas in this space, because when I initially switched over to L1, around that time, my thinking was, man, we've seen so many ideas come out, so many projects come out that are competing, that mergers and acquisitions are the next big thing, because all of these have to get consolidated in order to survive, right? They can thrive in a bull market, but in a bear market, they need to consolidate to thrive or to survive. So Ferrari, Faye being a stablecoin platform over collateralized, backed by, I'm going to throw out too much jargon here, backed by liquidity pool shares, essentially.
Don't worry, Martin will just jump in and call our bullshit. So, right, Martin?
And
to a certain extent, at some point, I just give up. I'm just like so down the rabbit hole at this point. It's fine.
Yes, please.
We have 4 really dedicated listeners right now.
I'll try to translate it as much as possible. But yeah, so Faye stablecoin protocol, and then Rari, a permissionless lending platform. And they were super aligned. They both had very young developer cores, very talented developer cores, super aligned in their mission. And they realized that by working together, they could probably achieve more than by separating or by working against each other. And so they decided to do a merger. At the time, we were doing the Threshold DAO merger, and the Threshold DAO merger took like a year, and they did their merger in like 2.5 months. And we were just blown away by how fast they were able to do this. But then, of course, when you merge into another company, you absorb their liabilities, right? And you can think about protocols the same way. And so these two organizations merged, and of course, the worst, Murphy's Law, the worst thing happens, right? Where Rari gets exploited. So Rari loses about $80 million through a hack, and that creates a significant bad debt. Now, this is where it gets interesting, because
We back up there. So I have 2 questions on that.
Yeah.
So one is, what was the organizational structure of each? Do you know? Was
both,
it a C Corp, or they're both C Corp?
No, so they were both DAOs, and then they had, venture funded.
But what was the
Yeah.
legal wrapper?
So the DAOs, no legal wrapper, and then the venture funded entities were like labs entities, which are typically Delaware LLCs, right? And so that's what we always see. We see service provider to the DAO and DAO, right? The DAO could be whatever. You can give it a legal wrapper, but if you give it a legal wrapper, all of a sudden you have to know every token holder. And in this case, they didn't know the token holders, but you have, I think, Faye Labs out of San Fran or Delaware, and Rari Capital out of, I don't know where that was based. The treasury itself was not owned by the labs entity, right? It was owned by the DAO and the multi-sig and the governance system there. And then you have this hack. Now, what's interesting is if this hack happened without the merger, the assets would not be there to cover the liability. But because they had merged, and because Faye is over collateralized and actually was doing pretty well, they had the option, which is incredibly rare, to actually pay back the exploit and to cover it entirely with their balance sheet with like not significant damage to the company. So of course, they put forward this proposal, and then somewhere in the middle of having this proposal out there, which is pay back the people who were hurt by the hack, somewhere in the middle of this proposal, we started to hear some rumors of SEC getting involved in some things and sending some letters. And surprisingly, the proposal gets voted for, and then like a month later, nothing happens. And then we see a new proposal come out, and it pretty much says not to do that. Let's take another vote and let's change it. And this is kind of where you're getting into the idea of like the governance just simply from that merger was simply not well thought out. It wasn't planned out.
Yep. And then like tying so much of it to token kind of put them on a path where they're like, well, this is just the way you got to do it. There's got to be and it's funny you mention it too, that you're absolutely right. Like they did pass it and then nothing happened. And then they passed another thing. We're like, let's just forget about that one and see if it passes this time. Like we'll do it again for no real reason, actually. Right?
No explanation at all.
No explanation whatsoever. And then I don't remember that one passed or not, but where they're at now is essentially that Faye, I believe, has decided that they want to like wind down the protocol And so the people who are still owed money are sitting there going like, well, wait, what about that proposal that passed? We're still owed stuff from that. And they're like, yeah, okay. And then when you start to get into the table of repayments in the proposal to wind down the protocol, essentially something like 2 to 5% of the amounts that were lost are being paid back to most people across the board. And so like, it's so many open questions, and there's no doubt that you hear rumors of like the SEC going, murmurs.
Of course,
and stuff
everybody's heard them.
Yeah, absolutely. Because it's like, this is like, can you imagine something like this going down in a court? Like I can if you're winding down bankruptcy.
The crazy thing about this is like in our traditional system, right? And I'm not saying the system is the best system, but I think there's a lot of precedent for why we do it this way is like when you wind down an entity, you pay out the debtors first, like the debt obligations first, and then the equity holders second, because the equity holders took that risk, right? That was kind of like how this works. They decided just to flip that.
Hey, because we can.
Yeah.
Why not? Wild stuff.
I guess so just coming back to kind of the structure issue, right? Because I'm just trying to think about like who is going to go to jail here, who is the SEC going to go after. So in this structure where you have essentially a DAO that has no legal wrapper that's being serviced by essentially the labs here, but is being serviced by an entity, and that entity is probably holds one of the multi-sigs, and then there's people behind that entity, right? Is that kind of the structure that is one of the people behind the multi-sig is probably the principal in the entity that is servicing?
Certainly.
Right? Wouldn't you be able to pierce the corporate veil of the DAO and go after whoever was in charge of the service entity?
So there's a few things going on here. The first thing is what we talked about initially with this governance proposal getting passed to pay back the debtors, right? This was pretty clearly a decentralized conclusion and decision that was made. They were reasonably decentralized. There's a lot of token holders that are not the labs entity, right? And they all voted for this decision, which is kind of the surprising thing because that's a really good defense to the SEC. Hey, we don't control it, right? Like these people made this decision to do this. We have one signature on like out of a 9 signature multi-sig, right? Like that would be an amazing defense to say, hey, we paid back the bad debt. Like we're in the clear, right? But the weird thing here is that they didn't do that. Then more directly answer your question, Martin, like, can you kind of like pierce?
Who is we here? Like, is this particular individuals, or is it like who, when you say we, they didn't do that, like who is they, I guess is a.
Yeah. So it is the labs entity. So I would say it is Fey Labs, right?
Okay. So like, are the people involved in that entity now in Mexico, like hiding in a closet, or like how do they?
No, they're still posting on Discord. I think I saw it. They're still posting on Discord. I have heard that they have not been talking to a lot of people, but I assume that they are building up a legal defense of sorts. But yeah, I mean, like you can certainly pierce this corporate veil. But even more dangerously, I think, is the fact that when you have these unincorporated DAO entities, in America at least, like they're going to see this as an unincorporated partnership, right? Yep. So joint and severably liable, right?
Yep, exactly.
Yeah, so I was doing I do not want to derail this conversation, but I'm like super fascinated by this.
Please. That's why we took the path.
Thread to pull.
I did a bunch of research on brain trust these past couple of weeks on just the token allocations and kind of who controls governance of brain trust. And effectively, the founders control all of the governance and control of brain trust right now. And I would think that would be a serious target for the SEC. Just if someone digs into kind of the governance proposals, it's very clear that this is not a governance token, that this doesn't really pass the Howey test. And so in your experience, do you think that this unincorporated DAO serviced by an entity is the best way to structure these, or would you recommend that the DAO actually be incorporated?
We'll take a quick moment to interject that I'm not going to give any legal advice whatsoever. And I'm not qualified to give legal advice here.
Yes. And also we'll add that to the intro, but yes.
Yeah. So I think what you're getting at is something that we've known for some time, been building for some time, which is the fact that US regulations, especially securities regulations, do not account for this new model where you can use equity as a reward mechanism as well, right? Like, so this is something that needs to change. And the reason this needs to change is frankly, because security should not only be for rich people. People should be able to buy things that can help them out financially. Now, consumer protections, all of these things, right? Those things should exist, right? We should be careful about like, hey, we shouldn't let anybody in the world issue a security without, like going through some type of hoops. Put that all aside. Securities are things that produce value and that are valuable. and there should be no reason that people can't invest in them. This is the issue here, right? Is that you want to have this DAO structure where you have this token that has governance rights. And what do governance rights mean? Governance rights mean that you can pay yourself dividends, right? You can pay yourself your capital. You can dissolve the entity, right? These are all things that are incorporated within governance rights, but you can't do that because then, of course, it becomes a security, and now it's an unregistered security. And now you have this huge liability, right? So this is kind of the dissonance here, is like, there is no way to do a DAO in America compliantly unless you do something like what Tribu Labs does. So Tribu Labs, they limit it to 99 seats. You have to be an accredited investor, KYC, big hurdles, and it works. It definitely works. But I guarantee you talk to Aaron, and Aaron's going to say, I wish I didn't have to limit to accredited investors and 99 people, right? So that's kind of the only thing I can recommend to US citizens for a DAO is, go with your Delaware fund wrapper and be a Delaware fund. And I don't know, do you really even need tokens?
Good point.
And then if you're outside of the US, like, hey, use a governance system that works like Governor Bravo or something like that, and have some reasonable, something that you can actually implement on chain. Hey, we passed a governance proposal. It's not a multi-sig because it's Governor Bravo, right? And we paid out people in a decentralized fashion, and now you're protected, right? That's kind of how I would look at it.
And has there been any update to this token safe harbor provision that the SEC proposed like 18 months ago? Have you heard anything about that?
Yeah, it's been a little bit radio silent, but I hear some progress on it. There's nothing I can point out to say like, hey, that's making progress, but it's inevitable. It really is inevitable. And I think if that comes out, it would be absolutely massive for US innovation in the space.
Awesome. Cool. Thanks for the rabbit hole.
Seriously, because I think like the rabbit hole led us to a really good place, which is we've now covered don't token, not when token. And then once you have don't, now when you get to like, when should I token? I think it's a good idea to sort of now begin to look at what L1D is considered good tokens, at least tokens that are worth supporting, protocols that are worth supporting. And I think there's some really interesting stuff that I'd like to dig in there as well, because you said this thing a while back around, well, if you're able to make a market that wouldn't exist in any other way, then that really makes sense for you to have a kind of token around it, right? And we've had a number of people on the pod who've been working on protocols like that. There's decentralized compute protocols that are using a token to ration resources for compute. There's all kinds of stuff out there. And I think some of the stuff in your firm's portfolio is really interesting. So Martin and I are both co-investors with you guys in Molecule. And maybe this is a good spot for us to sort of take another path and say, now we've covered what you shouldn't do. What sort of attracted you guys to something like Molecule?
Yeah. I mean, so the main thing that attracts us to Molecule is certainly the idea that it's like a long-term call option on monetization, right? Like, so maybe we take a step back and explain what Molecule is. That would probably make sense. So Molecule is a governance and NFT framework for issuing or for selling IP and purchasing IP. And specifically, like the initial focus of where they're applying this technology is towards like biopharma research, decentralized science aspect, like areas. The thing that attracted us most to Molecule, and I'll speak for myself because I think for everybody, they have kind of something different that they find interesting in Molecule, since it's a very deep and fascinating and unexplored area. But the thing that attracted me first was when I heard about it, I go, this is a really cool idea, but like, there's just no way that any researchers are going to want to change what they're doing to go over to this. And then I open up Molecule, the web page, the web app, and I'm scrolling through this and I see like 400, 500, 600 applications for research, like funding. The marketplace came to it, right? Like it just came out of thin air, thanks to Paul and Tyler and all of the work that they put into it. And so to me, it was like, man, the only thing that would prevent me from investing in this, they've already figured out, right? Yeah. So these researchers are, of course, drawn to this. And I think the main reason researchers are drawn to this is because everybody and their grandmother knows that there is criticism about how academia does grant funding, right? And this happens from having weird, perverse incentives from all sorts of corners of the earth, right? Whether it comes from the White House, whether it comes from China, whether it comes from your publishers, or even the students going to the school, right? Like all of these things make it so that schools cannot make honest decisions when it comes to where they're putting their funding. The NIH has like actual problems with throughput, right? Like they have a ton of stuff that gets applied and they don't know any way to differentiate it. So
yeah, that makes a ton of sense. I think for me, as a former scientist who has had to write grants, when I looked through, mechanisms for this, I was like, well, Jesus, there it is, right? This makes all the sense in the world. I know like plenty of my former colleagues who are now, at ritzy institutions like Berkeley and MIT and Max Planck, who are like still at the end of the day, they are glorified grants writers. And I just, I'm like, yes, you are discovering new scientific facts, my friends. But at the end of the day, wouldn't you want to do less of that? Less of the grant writing?
They spend like 80% of their time writing grants, right?
Absolutely.
And I mean, I remember when I was in the US applying to schools, and everybody, all of the people that were older than me, they were so jealous because we had the Common App, right? And the Common App, this magical application you can fill out. You fill out all of the information, you press a button, and you can apply to every school in the US. And it just makes sense. I mean, why wouldn't you want to have this, right? So Molecule is a huge innovation on that. And the DeSci aspect right now is focused on kind of like biopharma, biotech, right? All of these areas. I'm really interested in when this expands over to something like semiconductor research, right? And this IP can all of a sudden, this market to us is gigantic, right? We always talk about how NFTs right now, they're a bunch of comics and toys. But in the future, like digital things are digital things and most things are digital, right? And most things are not fungible, right? So the whole idea that you can organize DAOs around investing into non-fungible IP is super fascinating and super interesting.
Absolutely. And I think, like you said, it's fascinating. And also it addresses a real market problem, right? Because like the other thing I'm not going to speak for Martin, maybe he agrees, maybe he doesn't. But for me, what really attracted me to it was the fact that you can mobilize a ton of innovation through IP in these markets, because the IP that is produced, when you think of the biotech industry and the pharma industry separately, pharma for about the last probably 20, 30 years has very much outsourced this innovation arm to biotech firms. They wait for that IP to become valuable in the 500 million to billion market cap regime. They buy it and they commercialize a drug that results from it. And that's all well and good, and not actually criticizing for that, it makes a ton of sense for their business models. What ends up the other side of that is that something that doesn't have a total addressable market, even approaching that, doesn't have a chance of being brought to market.
Right.
And so this is a way for people to then say, hey, we produced IP for a rare illness that has a market of 10,000 people on Earth. And those people are fucked, essentially.
And not only that, but those people, that special interest group, right? The family and friends of people who are afflicted by some special illness, right? They can go ahead and they can invest in this. And then when this comes to market, they have an actual subsidized version of it because they are getting a benefit from this directly, right? So they can now all of a sudden provide it at lower cost than anybody else to the people who actually are afflicted by this disease. And then if something magical happens where they discover, hey, this medication works for something else, all of a sudden these people not only cured a disease that is massively impacting their life, but now they're also making money and helping other people, right? When we talk about venture frameworks, right? This is the magical, right? This is the thing where you say, man, this just was not possible in 10 years ago. And all of a sudden you flip a switch and this thing can happen. And the details, the devil's in the details, of course, right? The remaining questions here are, how does a token work for this? How do you make governance that actually survives, and that can stay intact and that has the right incentives in place? And these details are not impossible questions, right? Like these are obstacles that Jahed, you and I both wrestle with on the daily, right? And I think we're getting much closer to really strong answers for these what I like to call low hierarchy organizations.
Yeah, so maybe just before we go on from this, Jahed, it'd be useful just to bring this full circle to previous episodes to talk about Molecule in the context of Savvy and how Savvy fits into kind of the differences there and how Savvy fits into the pipeline of drug discovery and where they fit within the Molecule kind of DAO model.
Definitely. I think so Jake, I don't know, we may have talked about this a bit, but Martin's mentioning the platform co-op I used to run product for, and whose CEO is actually on the pod a few episodes ago, Savvy Cooperative. They're an interesting case for this. And also Martin, they are going to be probably working with Molecule to provide patients for some of these groups. It's a super interesting synergy that they was connected on. But basically The model for them, right, is that the patients own 51% of the cooperative, and the cooperative's only job really is it exists to provide patients for qualitative research projects, right? And so they essentially work with all of the top 20 pharma and most of the top 100 to essentially say, hey, you are trying to bring X product to market. Have you actually got someone to use it and to tell you what it's like in their day-to-day life and to actually see if it's a viable solution to a market problem, right? And this kind of blows people's minds because like we've been working in Silicon Valley for however long, right? We're like, yeah, of course they did some user research. What's your point? It's like, no, actually, most of the time they haven't, right? And so now what's interesting about this is that the innovations that come from that platform and that interaction, they do not own, right? The things that come out of an interaction with Pfizer or with, I'm making this up, I'm not really saying that they're a customer, just in general, right? If they go do a Pfizer engagement, that the insights belong to Pfizer, but the data, the identity, anything like none of that belongs to Pfizer. The co-op has rights to all of that. So they can preserve privacy. They don't have to give you an identity. They don't give you recordings. You get a report and insights and you can join the calls, of course. You can do whatever you want, but they preserve privacy in that way. And then they also take a percentage of revenue, they fold it back in the co-op, it's paid out as dividends. So you have a clear dynamic to say, hey, I should go find my friends who have chronic illnesses, anyone who has a rare disease. They should be a member of the co-op. They should get business into the co-op. We all benefit. We all win, right? So that is different from a token dynamic because you don't actually need to hold a token at all. It's either standard, I believe it's incorporated as, it's a really messy diagram because of all cooperatives are messy because of all U.S. co-op law is shitty. But basically, there's a Colorado co-op, right? And so when you look at something like this, yeah, exactly, Ligopolis, exactly. And so when you look at something like this, and you then sort of provide the context that Martin was asking for, and what Jake just elegantly went into, I think it shows you that there are these two emergent paradigms. I would say one, at least co-ops, it's re-emergent in the platform co-op sense. They've been around for a long time, but they're now starting to actually really align incentives with their stakeholders. But there's that last bit of things that might be unlocked by smart contracts or a multi-sig or something that can really help them scale. And it's really fruitful. It's a fruitful time for all of those to kind of come together. And it's kind of what we're seeing on our side, because with our background and what's happening in Molecule and other things in decentralized science, there's no way that a group like Savvy stays outside of that. They're looking at like, how do we get involved, right?
It sounds like such a natural fit.
Exactly. And so I think like coming from there, you showed a great example of how this would work with Molecule. Why I love how you touched on essentially with Molecule. Like this is a great example of something that would never happen without a token or an NFT, right? And there's both now with that. There's something that's spun out of Molecule as well, VitaDAO, right? That kind of serves as an arm to basically shape some of these projects and incentivize them so that folks can say, hey, I went out and got this researcher, famous researcher, or Pfizer or someone, which they did get Pfizer. It's peanuts for Pfizer, but they're putting 500K into Molecule, right? And that says something. But now maybe if you have any involvement with VitaDAO, I'd love to learn kind of, maybe you can tell us a little bit about how Molecule and VitaDAO relate to each other and what excites you about it.
Yeah, so VitaDAO is the use case of Molecule, right? So you imagine Molecule as this underlying infrastructure to create IP NFTs and then to transact upon these. And VitaDAO is probably the first major use case. And like I said, this focuses initially on pharma or on bio areas. VitaDAO is looking at like what we would probably categorize from like a Silicon Valley standpoint as longevity, and what pharma people would categorize as like neuro health and your organs that take a lot of wear when you get older, right? So VitaDAO is looking for, how can we be optimizers, right, in the biology point of view? And so VitaDAO is essentially, I mean, not to like over decorate it into anything or say what it is, something that it isn't. VitaDAO is really just a relatively open source, permissionless, decentralized VC for longevity products. And their focus is specifically on driving value, like being a value add for super early stage research, right? So a lot of early stage research asks way too much in funding, doesn't know how to use their resources really well. And you get this organization of 200, 300, 400 expert researchers. And all of a sudden, these guys can advise you on how to best set up your trial so that you have success to go to the next stage, right? And I think this is the first iteration of Molecule. Of course, in Molecule, you'll have SciDAO, which is the psychedelic focused version of this. And each one of these is interesting because you imagine monetization for VitaDAO is pretty obvious, right? Like longevity products can sell and can be licensed and can be worth a lot of money. When you look at SciDAO, monetization isn't so obvious, right? Because like I think myself, along with a lot of other people in the psychedelic community, would say like, yeah, this stuff isn't meant to be monetized like that, right? Like this isn't mass market. We don't want this at Walmart. Like this shouldn't be, the incentives aren't there for that.
Get your safe Walmart LSD. Yes, absolutely.
Yeah, but I would actually push back on that because like what percentage of Americans today have some sort of anxiety disorder or post-traumatic stress disorder that could be, or alcohol?
That's a good point.
That could be like, these are communities that in the same way that a group of 10,000 people that have a rare disease could be helped and come together and say, we actually want research into psilocybin to help with PTSD, or we want research into microdosing LSD to help with anxiety, and could come together around that. So I do think that there is potentially a similar model.
1,000,000%, but here's where I see it being majorly different from like a commercial standpoint. Is the dirty little secret is a lot of big pharma doesn't want to cure you, whereas psychedelics do want to cure you, right? So like they want to treat the underlying, and when you have revenues associated with a product, your incentive is to get people to continue to purchase it. Whereas with psychedelics, like our incentive is kind of like, we want to cure like the mental ailments, right? And so like the economics are, I want there to be an easy way to implement the economics such that the incentives are to get this out to as many people as possible. Yeah. At the same time, we have to be very careful because if you implement the economics wrong, then all of a sudden you're shoving psilocybin down a 7-year-old's throat because, you know, had a tough day at school. And it's like, that's not the way to do it, right?
And I think it's a very uncontroversial statement. I mean, the pharma.
By the way, before we get into that, I would be very excited to be in that second grade class.
That would be a great class, wouldn't it?
I can bring this dream. This dream can come true for both of you. I have an 8-year-old son, so I'll report back. And that is purely a joke. No one sue me, please. Of course. But I think what you fleshed out there is a great example too, since you clearly been working in these DAOs quite a bit. You understand how they work and their goals and what they're trying to achieve. I think this is a lot bit that I'd love to touch on with you is basically there's this, and you demonstrated very much so with your background and what you're working on now, is that there's this other sort of emergent group in VC that I think the first time I saw it was a really awkward term I'd seen around like operator investors. Those have been around for a while, right? And then there's like Han Ventures made a big splash with their $1.5 billion fund or whatever it was to, I don't know, it keeps growing. But in their inaugural sort of mirror post announcing the fund, they coined this term venture contributor, which probably existed before they did, but they really leaned into it. So I think you in particular seem to really touch on a lot of that. So I'd love to hear a bit more about how important do you think this is as a paradigm for VC going forward? Should all of them become contributors? How do you think it applies?
So 100%, I think it's a new paradigm. And I agree with you. The first time I heard about it was probably the Han Ventures call. But I think VCs are naturally really strong fits for contributing to DAOs because one of our jobs is to discover problems. And right now, the way to discover problems is to actually work until you find a problem and then try to figure out what the solution is for this. I know that there are tons of people out there who are in jobs where they just don't have the capacity or the time to contribute DAOs. And the goal is to get DAOs to a point where it's easy enough to contribute for those people. And until then, it's going to be a lot of VCs like pushing. I've told you, it's like pushing this really, really heavy rock, right? And like a bunch of people go off to take like a smoke break and you're still pushing it. It just gets heavier and heavier. And for a long time, it will be a lot of VCs. And it's kind of our duty, right? Like, because I see that there's two types of VCs and VCs do get a really bad rap, you know, in crypto for legitimate reasons, right? Like VCs have done some stupid things in the space.
Absolutely.
But there's two types of VCs. There's a type of VC who raises a fund because they're going to get 220 on the capital that they raise, and they invest in stuff that they think will be big in a few years because that will pay them and they will be happy. And then there's the other type of VC, which says, I'm raising a fund because I know where I want the world to be in 5 to 10 years. And the only way we're going to get there is if we start allocating to these projects that are getting overlooked. And if we start helping these people build the stuff. In the latter type of VC is that venture contributor, right? Like the person who is willing to do the really, really monotonous work of going through the DAOS transactions and doing the reporting for the accounting because somebody has to do it. And, fortunately, we get paid to find out where these issues are, right? So that's how I see it evolving. In the long term, I think ideally we build ourselves out of that job, right? Where we figure out, hey, these guys are making an incredible product. Let's invest in them. That solves a huge issue I have in the DAO space. And so eventually you solve all your problems. And now you have actual governance frameworks that can work with low hierarchy and like low touch contributions.
Yeah. And I think that's a great point to make your contributions a little more. You're public about which ones you work in, right? Or are you a non? Do you mind if we discuss them?
Oh, yeah. I'm very public.
Okay, cool. Just want to make sure before I just jump in and out you. So you worked with the DAO I'm a steward of and the DAO you work in, I believe the Paladin you were working with for a while. I only pick it not because it's super interesting, but more I want to know a bit more about you as a contributor, right? So how, you mentioned a lot of things. You're basically carrying the water carrier. I mean, for some of the things that other people are just like, yeah, whatever. Accounting, what's that, right? So someone rolls their sleeves up and does it. How are you thinking about, for folks who want to get involved in DAOs, right? There's a lot of shitty advice out there where it's just like, oh, just jump in there and join the Discord and all that. What have you learned so far about this? How should people get involved?
Yeah, the best advice I ever saw was get good at something, right? Don't get good at something in crypto. Get good at something in the normal world, right? And if you're good at something in the normal world, you can guarantee we're going to need that help in a DAO. So accounting, business development, marketing, content creation, tweeting is a good skill. Now, the only talent that is only useful for crypto, Discord mods, right? And everybody sees Discord mod as like an easy way to get into the industry. I've modded way too many servers, and I know that the value out of them was relatively small, right? You spend most of your time just like having notifications on your phone for Discord, and it's mental. It's a destructive activity. I would say,
Absolutely.
Yeah. So dig into accounting, dig into finance, dig into marketing, any of these things that traditional companies need. Get really good at that. And if you're really good at that, then you can contribute those skills incredibly well to an organization that desperately needs them.
Got it. And then now, let's say that happens. We start in the next bull, we really attract a lot of folks and we go with strong skills, people skill up. What do you really see as the bull case for DAOs? What do they go after? Like, what is the thing that they really help us coordinate around?
Yeah. So I'll give two different frameworks for thinking about this. The first framework is to kind of understand like just a high level taxonomy of DAOs. So not all DAOs are the same, of course. There are protocol DAOs, which is our initial understanding of DAOs. Your Maker, your Uniswap, all of these things are protocol DAOs. Then beyond protocol DAOs, you have service DAOs, right? Vector DAO is a great example. Spearbit DAO is a great example. Dev DAO is a great example. These are just traditional service businesses, but kind of like Uber style for these, right? And then the last thing that you would have would be social DAOs and investment DAOs. Investment DAOs are just investment funds. Don't let anybody fool you. And social DAOs I think social DAOs are some of the most rewarding and probably the best way to enter this industry because you can build up some connections and network really easily in these. That being said, the bull case for social DAOs is probably not massive, right? Community can only be so big.
I think the market is proving that out, even though I count a lot of social DAO folks as close friends of mine and I love what they're doing, but the Forefront and Meta Label and all these folks, I think the case, it makes sense. It ends up just being a nice club for you and your friends to do work the way you want to, right?
It's a club. It's a good networking group. It's a really positive atmosphere. It's a great thing to be a part of. It's not super bullish. But the super bullish thing I see are service DAOs and protocol DAOs. And on the protocol DAO side, what is the bull case? Well, the bull case is the endowment model that we've seen. This is a typical playbook, right? Harvard, MIT, etc. What you're doing is you're gaining a bunch of resources. You're managing these resources so that you can manage your maintenance, and you're growing the endowment faster than your inflation, right? And that is a standard playbook. It will work tremendously well in a decentralized fashion. And way better part about it is instead of a bunch of people over at Harvard smelling their own farts, like anybody can participate in this endowment. Sorry, Harvard.
I love it because Martin's a Harvard MBA, but we dump on him for it all the time. Don't worry about it.
My dad's a Harvard MBA too. We all know what it is. Then on the service DAO side, and this is where it gets really interesting because it's not so clear, right? But on the service DAO side, the bull case for this is ZK technology. So zero knowledge unlocks an incredible amount of work that you can do in a service DAO, because a lot of these things you need privacy for, right? Like your traditional, the whole reason we have GDPR, and GDPR is a really important law because it protects us from complete negligence on the corporate side. There's issues with it, of course, because any law that gets put out there has issues. But on the DAO side, we need a way to manage the contributor information and the consumer information in a private way that doesn't compromise their identities, doesn't put them in danger, it doesn't make them do things that they don't want to show the world. And if we can do that with the zero knowledge tech, even something as simple as ZK voting, right? But we can get even crazier, like ZK payroll or et cetera, et cetera, et cetera, or ZK document shares, right? Like things like that.
Yeah.
All of a sudden you can onboard a massive amount of businesses that are in the digital realm that are not in crypto yet. And that's the bull case for DAOs.
That's awesome. I've never heard anyone say that before. And I think it's really super interesting because, and just before we'll wrap up in a little bit, but the zero knowledge, just so everyone knows, the simplest way to explain it is with zero knowledge proofs, they were discovered in the 80s. Essentially, the simplest way to conceptualize them is that you can reveal certain information. You can answer a question that someone asks. If you think of it as someone asking you a question, you can answer that question. You can prove that you've answered it and you don't reveal anything about yourself, essentially. Think it could be the simplest way to conceptualize it. So think about a situation where this happens to me, right? Where it still happens to the goddamn year 2022, right? When you're filing your tax or something, someone goes like, hey, yeah, I sent you the PDF, but call me so I can give you the password to de-encrypt it, right? And it's just
what about even the crazier thing where you go to buy a house in the US and you need a proof of funds and you have to like take a screenshot of your Bank of America app and show the broker exactly how much money you have in your Bank of America app, when instead all we could do is just a simple proof. Hey, are my funds above X? Good. Yeah. Right.
And by simply solving a proof, you're able to show that you can answer the question, but you don't reveal any of the details. Right. And so that's the simplest way. And then that, like, as Jake pointed out, like you basically unlock a ton of corporate and freelancer use cases, all kinds of things.
Huge amount of freelancer stuff.
Yeah.
Yeah. And if it still hurts your brain, the ZK stuff, just look up Alibaba's cave. That's like the textbook example of what ZK is. And don't try to dive too deep into this stuff. There's smart people doing that already, spending their entire lives on this.
Yeah, absolutely.
Yeah, and it was the Jaya that was working on this, Jahed, and is that the episode?
That's right. It is indeed. That's NIM is doing mixed nets, and then they are providing us some zero knowledge as well. And so that would be a good place to go take a look at that and to really dig into privacy. Jake, this has been awesome, man. Great winding path. We just kind of struck out here with you. Thanks for your time. The last bit I'd like to throw your way is let people know where they can follow you online, follow your work, and follow L1D's work.
Yeah, absolutely. Man, it was an absolute pleasure. It's always a blast talking to you. And Martin, thank you for having me on. You can check me out on all social with Lakejynch, LAKEJYNCH. And then L1 Digital is just L1 Digital. So feel free to look us up. We'll be around.
Awesome. Thanks a lot, Jake.
Thank you, guys.